Okay, here we go with that intro that we all love.
Let's do it.
Welcome to the New Age Wealth Advisors Thursday live stream. Kind of quiet day in the markets here, right? What's going on with you? Anything good? No, I
What a
shouldn't.
difference! What a difference a day makes.
Holy
After
cow! Right?
Yesterday's news and bounce into today's trounce, I guess. I mean, it's a wild turn of events. I mean, I don't know. Did sentiment change overnight? Did people digest what Jerome said in his news conference yesterday? It's hard to make sense of how drastic the reversal has been. I think we were all expecting the news yesterday, and even some of the good news was a little unexpected that maybe we're not looking at a 75 bip rise for the next meeting, but yeah, today markets did not handle whether it's news from yesterday's meetings. I know there's some weakness in some earnings that have been coming out, so a lot of different directions we can go into. But yeah, today's sell-off has not been pretty, and as we approach close, was hoping for a little bit of a reverse or a little strength heading into the close, but it's not looking to be the case so far.
Yeah. It was like you said. It was a big difference a day makes, and I put the video out last night, just interpreting the big move up post Jerome Powell, where they cut 50 basis points, which 50 basis points is 0.5%, or they raised interest rates 50 basis points, 0.5%. And as you said, the committee is not actively pursuing 75 basis points, which is an increase in 0.75%. And the market kind of took that, but I respected it in the beginning when Powell came out and said, let's talk directly to the American people. We acknowledge that inflation's an issue. We take it very seriously, and it's hard for American families to plan their day-to-day expenses and their budgets with unstable prices, and we want to take that head on. And the market sold off a little bit, but then he took a very, I don't know what the right word is, nonchalant, sort of a blasé, a somewhat competent approach that they could do a few things, which is orchestrate a soft landing while stemming off inflation. And the markets believed him for a good period of time. And I think the markets got to think about it overnight, and they said, the way inflation's going, the way some of these commodity markets are trading, the Fed is going to have to be a little bit more urgent about containing inflation. And that's just sort of the, I think, the realization that came today. And Ryan and I were talking before, and let's just take a look at the markets here as we're going in. We've got about 12 minutes to the close, and we can see that the NASDAQ is taking most of the brunt of the selling here. So as we look at the NDX down 5.93%, we have a NASDAQ that's down almost 6%. Unbelievable move. We were up 3.8% yesterday, so certainly gave back a lot. The Dow's down 4 and the S&P down 4.4. So it's a bloodbath, on the screen today. Just looking at the other markets before we dive in, crude was up. Crude poked above 110 here in the open. Here's RBOB, which is the gasoline futures market, up 0.25%. Nat gas continues to go. That's a very sensitive market with what's going on in Russia and Ukraine. So nat gas is pushing up towards $9, which is amazing. VIX up to around 31. Dollar continues to go. Gold continues to be useless. And rates push back above the 3%. And that's sort of it's not only a round psychological level, and the way my charting software here is a little goofy. It should read 3.16% in the 30-year, 3.06% in the 10-year, 3.02 in the 5-year. So we're above that 3%. It's not only a round psychological number, but it's also sort of a technical downturn resistance. So we're breaking. The path continues to be lower just in the face of inflation. It's nasty out there, but I think if you saw the video, and I'd like to revisit the chart, just kind of putting everything in context as to, in the day, it looks nasty. You watch the news, it feels nasty, it hears nasty, it sounds nasty, I should say. But once you step back and look at where we are, where we probably will be going in the context of, the longer term, it's I hate to say it's not catastrophic. By a long way. What would say you, Rye?
Yeah, and just looking at today's sell-off and keeping it in perspective, we talked about it earlier between you and I, and we've talked, I think, in the past, just in terms of the expectations of what the Fed's going to do moving forward, and to a certain extent, and this is what it's, unfortunately, this is what the Fed was doing when it was going to raise rates. You can't predict the impact, the overall impact, but I do think as you see markets sell off, you're going to see some slowdown in spending. I mean, it's that wealth effect that we've talked about, and psychologically as people are seeing their 401ks or trading accounts, whatever it may be, that may rein in some of their spending to a certain degree, and that'll help inflation, right? I mean, that's the goal here, is to probably lower demand a bit and to reel that inflation in to a more normalized number. And the market's going to do some of the Fed's job for it. And
Yep.
It's probably a little bit of the chicken and the egg, like what comes first, did the Fed cause this, and what's going to be the response from the Fed as we move forward. But I do think the markets will dictate to a certain extent what we see from a rates perspective as we move forward. It certainly had an impact when we saw the sell-off from when Russia and Ukraine that conflict first started. We saw the Fed kind of pull back from what they were expecting to do, and I think the market will somewhat dictate that as we move forward. You hate to see it. I mean, it doesn't feel good as we're going through this, especially on a day when Nasdaq's down, a little over 5%, S&P's off, 3.5% right now, and certainly doesn't feel good. But you look back and these markets have done well since even pre-COVID, but especially since kind of like the midst of COVID and in the bottoms of COVID. And 2021 was not sustainable. And I know we talked about that last week, and so I'm going to sound like a broken record a little bit, but having little volatility, a straight up market, that is not sustainable. This is more normal than what we saw last year. Right. But I think we have to do two things. One, keep it in perspective, but also explore, where does this end? Is this going to be sort of like a longer lasting sell-off, possible recession, possible bear market? And those are the kind of things I'm trying to make sense of right now, and kind of looking at, big data picture and kind of what's the underlying economy doing, because, not all recessions are created equal, and not all, bear markets or corrections are created equal. And, I think there's a lot of key differences from what we saw in the last major market sell-offs. COVID as an exception. I'm talking more the global financial crisis and in the tech bubble from back in 2000, the dot-com bubble. Major differences, but right now, you have a real mass sell-off like today. It feels scary, especially in the moment.
I mean, there are a few things about that. Like, first, let's me. I like to keep things simple. I like looking at pictures and using crayons to draw on stuff rather than reading. And you look at the Nasdaq chart from 2009, from the global financial crisis, as you just mentioned. And I just like to look at just the naked bare chart here without any annotations, that I like to do, and just kind of step back. Everyone, take a deep breath. Kind of shake out the arms a little bit, get some blood flowing here, take a deep breath and say, look at this NASDAQ chart that we've seen. We're off roughly 20, 22, 23% from the high. The market is up multiple hundreds of percent from the lows. And if you kind of square that up with the barrage of bad news that's being thrown at us, we're up 1,120% right now from global financial crisis lows. From the COVID lows, you look at where we are. We're up 87% from the COVID lows. Right now, we're off at the close as we're going out on the lows from the highs. We're down 24%. So, let's. I think we can all agree as we're looking at a down 6% day. It feels horrible, but in the grand scheme of things, as much as is being thrown at the market from an inflation point of view, from geopolitical point of view, we're seeing slowing in earnings, possibly stress of the consumer. There's so much being thrown at this market. I think it's weathering it quite well. Now, that's not to say it can't get worse. But what strikes me, Rise, what's interesting is, we listened to the Fed forever beg for inflation because we had multiple editions of quantitative easing, which is buying of bonds to push interest rates down to stimulate the economy, to fight off deflationary pressure, which is falling prices, or disinflation, which is increasing prices at a slower rate. The Fed was asking for inflation for such a long period of time, and now they got it. And it seems like it's almost like be careful what you wish for, because it certainly seems like they got caught with their pants down. And I think, I can't help. I don't like to be someone who bashes public officials publicly. I mean, we'll do it privately, but you got to think about it. Like, why were they stimulating the economy so much, particularly buying of mortgage-backed securities months ago, while real estate prices were already spiking, pricing people out of the market? And now all of a sudden, they've got to really, really land. They've got to land this plane that is in a very narrow little aircraft carrier in this very tumultuous sea, hundreds of miles downrange. They've got to land this thing and orchestrate a soft landing. But they kind of get what they asked for. They should have raised rates a long time ago. They should have stopped buying bonds, treasuries, and mortgage back a long time ago, and they didn't. And they're going to have to deal with it now. So that doesn't help us. It doesn't help our investors. But that's the reality of the market we're in right now. And we have to adapt to this Fed that is being painted into a corner. The market gave them the benefit of the doubt yesterday, rallied up, and then they thought about it overnight and said, you know what, there's no way in hell they're going to be able to do this right now. So, tactical asset allocation is so key in here, and that's what we're doing. That's what I've spent all day doing besides prepping for this, just thinking about the right areas of the market to be in. And there's markets that have already undergone catastrophic crashes. I mean, we could see stocks that have just come off from major pandemic high valuation crashes. Peloton destroyed. Teladoc destroyed. What else? We throw some out. Even Netflix, which was a tech darling, destroyed.
Zoom, Netflix.
Zoom.
Any of the COVID high flyers have gotten beaten up and.
Yeah, so it's like that's why it's like there's a tale of multiple markets in here. Yes, the Nasdaq's off 20%. The S&P's probably 16-18% at this point. But there's been multiple pockets of stocks that traded so well. DocuSign from 318 to 80, and that's a good company that makes I think has a bright future. So there's been crashes in specific sectors, but there's also areas that are showing relative strength, and that's why it's so important, I think, to be a stock picker in here and know what sector and industry is sensitive to interest rates moving up and the Fed forced to raise rates. You could be in the wrong group of stocks and be down 80%, or you could be in the right group of stocks and maybe down 10 or maybe down 5. I mean, it's such a what's my word? It's just such a spread out, fractured market, I should say.
Yeah, and times like these it's always a good time to be a little bit more tactical.
Yeah.
And you brought it up. Some of these sectors or some of these companies have faced significant sell-offs. Even having Amazon down over 35%. That's major. These are some of the in the past companies that have weathered some of the storms. It's been such a solid stock, especially as a big holding, a big weighting of the S&P. But if anyone thought this bear market or sell-off correction just started in April, this has been going on since last summer with some of the underlying areas of the market, right? We've kind of seen this sell-off start. The full market didn't feel its effects, I think, until this year, but we've had a ton of volatility beneath the surface. And when you see some of the threshold of companies, both in the S&P and in the Nasdaq, that are down, 50%, down 75%. It's pretty significant, and you know, in a way, again, I think it was needed at some point. We needed to have some of these companies come back to earth. When you see pictures of JPEGs of monkeys and apes and robots going for $500,000, $1 million. I mean, this sort of environment cannot go on forever. And I've talked about crypto. I think there's a place for crypto moving forward. I think there's a place for some of the underlying technology of NFTs, but if you're dabbling in NFTs, I think that's an area that you're investing in an NFT, you have to expect, or you have to go in with the mindset that could go to zero type situation. But the entire market was just going crazy, just going bananas last year, and we're just kind of getting it back to reality. And frankly, like when you look at some of the underlying numbers within the overall economy, it's relatively, there's still a lot of strength. This has kind of been like the most optimistic recessionary kind of area. Not optimistic, because I think the sentiment is certainly negative. So I don't want to say optimistic, but when you look beneath the surface, I mean, employment's super, super strong. There's listings for jobs at like 11.5 million and only 5 or 6 million people looking for jobs. So we have a surplus of jobs out there.
I have your graphic that you put in front of me here, the job openings, unemployed worker. So we're looking at, walk me through this. So this is job openings, unemployed worker. So I'm reading 5.6 million more job openings than unemployed March of 2022. Kind of walk me through what we're seeing here.
Yeah, essentially right up until COVID happened, the last 20 years, we haven't had more job openings than we had people looking for jobs. There's always been more people looking for work than there has been job openings. And now we're seeing over 5 million more job openings than there are people looking for work. Doesn't mean all those people looking for work are going to be, find the right fits in terms of what they're looking for, and those openings aren't going to suit maybe what they need. But in terms of the robustness of the current labor market, the tightness in the labor market, wages still going up. They're not at the level of inflation, but I don't want to say it's transitory, because inflation, as we've seen, isn't necessarily transitory. But I don't think that 8-9% inflation is going to last.
No.
And
Go ahead. Yeah.
I was just saying, we're just seeing a lot of strength there, but I've never seen kind of the reversal of sentiment, and I think it all goes back to the inflation number that we've seen in the last, 4 or 5 months, let's say, maybe even a shorter period of time, because we looked at the investor sentiment numbers from last week.
Yeah,
they're worse than it was in the lows of COVID. I mean, I remember the start of 2020 in managing money for clients. I mean, it was scary. I mean, you truly didn't know what the pandemic meant, and with inflation numbers getting really high in a strong economy, people are more worried about the markets now than they were during the depths of COVID, and that's really interesting. It goes to show how much of an impact that inflation number has on people and consumers. And I think it's pretty clear that's leading to a lot of what we're seeing right now.
Yeah, I mean, there was even a time during the pandemic that we're like, should we shut the economy down for 30 days? I think.
Yeah.
Was it Einhorn? Not Einhorn. Who's the young money manager? Not Einhorn. Who's the other guy? You guys probably know. But he can.
Ackman.
Ackman, thank you. Yeah, Ackman goes, we got to come shut the economy down for 30 days. I mean, the Fed forced the economy into recession, but we almost really put it into a recession. So and there's so much being thrown, as I said, at the market. And this is a chart that I put into the video last night that I finished at 1. It's just that kind of market. The headlines: worst start to the S&P since 1939, worst Q1 since 1939. And again, you look at this and say, all right, let's kind of put everything in perspective here. As I said, the market is off, 20, where's my price range? So right now, some markets, S&P's off 14.5%. And then you people who don't follow the markets as closely as you and I, who have, let's say, real jobs, they read a headline like that, worst start to 1939, you think we're already in a depression, but like, all right, market's off 14%. Well, when's the last time the market's been off 14%? 2020, 2018, 2017, 2015, 2011, 2010. I mean, it's happened 6 times since the '09 low. It's important to kind of keep this in mind. The sentiment is extremely bearish, and like, look, we've got a serious nuclear power a leader who is unhinged, who's trying to reconstruct the USSR, who's using their commodity export as a weapon. I think we can't make any mistake that this attack on Ukraine is sort of a proxy war against the U.S. Because they know we're in a vulnerable position right now, and they're using commodity inflation against us. I think they knew, and plus, with the amount of outstanding debt the U.S. has, as this interest rates continue to tick up, the amount it costs to service the debt is astounding. Look at the wealth effect. I think we've lost, in the first 5 months of the year, I think we've lost about $14 trillion in stocks and bond losses. That's paper losses in American markets. The U.S. GDP is 26 trillion. We've lost half the GDP in wealth effect. And to your point, I think that is going to sort of take so much strain off supply chains and demand, ease off demand, and I think the problem will sort of unwind. And if the Fed does stay at 250 more basis points to go over the next 5 meetings, I'd be shocked. We have CPI coming up next Wednesday. They're looking for 8.5% year over year. Probably 0.6%, 0.8% month over month. So next Wednesday is going to be key with CPI, and we'll see what happens. But Jerome Powell said it in the meeting yesterday. Is so many people are writing with such conviction that the Fed is going to raise 2.5% this year. He says we don't know what's going to happen 3 months out. We're taking it meeting by meeting. He clearly said we don't know what's going to happen 3 months out. So you combine that with what I think is a relatively shallow pullback, combined with all of the horrible news that's hitting the tapes every single day with the Fed that is willing to be flexible. I'd be shocked if they raise that much. So the point is, I do think we find a low sooner than later. I don't think this is 2000. I don't think this is 2008. We don't have massive excesses anymore. We had it in a stimulus check fueled stay-at-home pandemic economy, but those stocks are already down 80%. They can't go below zero. I mean, the way some of these pandemic stocks are trading, they're on the way to zero. That's fine. It's over. Right? You look at Apple, stock's barely off. Apple is holding an incredible bid. Amazon, I think, is a stock that we're going to talk about in this show. That stock's been underperforming for a year and a half. I'm not surprised. I hate to say it, but Amazon for me is not an indicator of the American economy. I think Amazon earnings was terrible. I've got some stats. We can jump into that one. I think you and I want to talk about consumer discretionary, which was a big play today, and I think there's a couple bright spots and a couple ugly spots. But it just goes to the point that you have to be a stock picker in here. And Amazon nobody should have been overweight Amazon for a year. You just look at a simple price chart. Let me see if I can bring it up. It's been underperforming the S&P since 2000, maybe even 2019. Let me just bring this over here real quick and settle in there for me. Come on, baby. Flip this over. So this is just a simple look at Amazon, and this blue line is what I'm focused on down here. This is all we're doing is taking the Amazon and dividing it into the S&P. If this blue sort of chart, if this chart is moving up, Amazon is outperforming the S&P. If this one's moving down, Amazon is underperforming the S&P. Amazon has been underperforming the S&P since October of 20. We're coming up on, we're a year and a half of underperformance. So to see this latest breakdown for me is not surprising. And I think, you and I talked about it. They had a $7 billion loss in their latest earnings from their Rivian investment. So it's a combination of Rivian, Ford also got stung, but also I think how many of us just purposely just go in and do an Amazon Prime purchase that we don't really need? My wife and I were talking about it. She says she loves Walmart and Target grocery deliveries. We don't need to go to Amazon. How many of us just go in and just buy stuff on Amazon because it's fun and easy? We all have Amazon Prime. I think it's kind of like a Netflix sort of situation where when inflation goes up, we're spending more money, as costs are going up. It's an easy thing to cut. I don't think Amazon Web Services is a huge part of the Amazon deal. It's still 60-70% of the revenue is still just on their retail model, and that's a discretionary spending that I think people are smart who are watching their balance sheets. To your point, they're in good shape, and they know they can cut spending, but just stop making so many spontaneous Prime purchases.
Yeah, and I think there's two things I'm thinking about with companies like Amazon and Netflix. I mean, at a certain point, if you haven't been using them or weren't a subscriber, I mean, there's a market saturation that's got to happen as these companies just have been around for as long as they have and has been as popular as they've been.
Yeah.
That growth, that substantial growth rate is hard to keep up. The other thing is, e-commerce. I mean, that's what's been getting hit the worst today, and a lot of earnings, kind of this earnings cycle for the first quarter have been pretty bleak for e-commerce. We were talking about it this morning or earlier this afternoon, and I wonder, is this an indication of slowing spending? And it might be part of that, right? It might be part of this inflation number and people just looking to pull back a little bit. But also, how much of it is just kind of a redirection of people's spending? Because we've been locked in for so long. We've had waves of when COVID has reemerged and people have kind of pulled back. I mean, it felt like once we got through the holidays, it felt like this spring people were prices reflected that were putting so much money into travel and kind of experiences and going to Florida, going wherever, and you're seeing that. And I just wonder if like some of that spending in the e-commerce space and in the growth, the year-over-year growth, when last year, again, people were still on lockdown, people were not going out, they weren't, spending on services, travel, leisure, they were spending on, staying at home, Netflix, Amazon, all these other things.
Yeah.
Now the economy's, it continues to open, and we continue to, people are continuing to do more and get out more, and just that shift. And I think I don't know if you have it still in front of you, if we can look at it, but I would say today's, as we looked at it mid-afternoon, some of today's trading reflected that to a certain extent. I mean, all consumer discretionary was down, but
I have it queued up for you.
Okay.
Yeah. So Ryan brought this up, and as we're prepping for the show, he's like, let's think about, is consumer, and to put words in your mouth, is consumer spending habits shifting? Have they come offline? Have they gone off online? Have they gone out to brick and mortar physical locations? And we started a conversation, and I said, it's a good point. So we started looking at. Do you want to set it up, or do you want me to keep going?
No, I mean that was kind of my thesis. It's like, okay, because the news on e-commerce was so bad today. Again, is that an indication that people are slowing overall spending and it's sort of recessionary concerns, or is it a little bit of maybe spending shifting coming out of COVID and coming into another reopening? Because I even see it I'm in Boston, I see it with some of the families that my kids go to school with. I mean, some people have still, even through this past winter and early spring, we're still kind of in lockdown for the last 2 years, and it's only been recently because they either got COVID over the holidays or they're finally a little bit more comfortable that they're going out. And I think people are just getting out in the world more, and that is that shifting some of the spending habits versus what we've seen the last couple of years.
I mean, I got in a battle with my kids, and by the way, this is gonna tie into what you're saying. I got in a battle with my kids over Roblox. Like, I was fine with them spending a lot of time on Roblox while the stock was making money. Now it's a piece of shnikes.
That tune as well.
So now I'm cracking down on them, and I actually spent some time. There's a nice Netgear Circle app that allows me to monitor and set the time on them. I had a war with them. I mean, they're obsessed with it. It's way too much. Roblox is a perfect example. Stock went from 120 down to 30, and you know the kids are getting outside. Today's the first 70-degree day, and it looks like it's going to shift here in the Northeast. To your point, I think it's time to get out. It's time to get out. People are more budget conscious. I think people, because of all of the the bubbles that have happened. Tech bubble popped in 2000. Housing crisis 2006-7 popped in 7-8-9, almost took down the American economy. We've seen Bitcoin crash multiple times. The consumer and the investor is much more savvy because we have, I think, because of the rate of information, we're in the digital age, the new age of information, which is why our company's New Age Wealth is increasing the frequency of these boom bust cycles. And I think the investor and the consumer is more savvy to it. And I think they're quick to cut this. And to your point about where's that spending going, I thought today was very, very interesting. Consumer discretionary, and the way we look at this is you have the stock indexes, S&P, the NASDAQ, the Dow, and the Russell. And then below that, the way we look at it is we look at the 10 sectors that make up the S&P. Okay, let me just bring this over without blowing up my software. Okay, so the 10 sectors that make up the S&P, and I don't have the names, but I'll tell you what they are. They're utilities, energy, staples, healthcare, real estate, industrials, financials, materials, communication, technology, and consumer discretionary. And you just quickly rank
Defensive definitely held up better today as you go through
100%.
that.
Dude, XLY was actually off the worst levels. It was down 6%. It finished consumer discretionary down 5.6. Tech down 4.8, communications down 3.7. I mean, those are your tech stocks that led, in communication and discretionary that led in the way up. And to your point, utilities, they were hanging down only 0.6 for the day. There's energy, which has been a rock star, staples, healthcare, real estate. I mean, it couldn't be any more clear in terms of stocks that lost less were defensive. Stocks that lost more were the offensive growth. And that started the discussion with consumer discretionary. Consumer discretionary got rocked today. And if we look at how the industry level, to Ryan's point, the stocks in consumer discretionary that lost the least were hotels, right here, travel, restaurant and bars. Okay, those showed the best relative strength. And if we scroll down here, the ones that got hit the most were automobile, which is Tesla. Tesla got rocked today, down 8%, give or take. Clothing, footwear, recreational services, sort of a mixed gambit up here, like sort of a mixed up here in terms of what was really, getting hit the most. But I think Tesla was the big one. But travel did extremely well and has done extremely well. And I'd like to flip through some of those travel stocks, if I can, specifically within hotels, which did the best today. And Ryan kind of set me down a rabbit hole here, which is really good. And just for comparison, let me throw the NASDAQ. Okay, so here's the NASDAQ, just to give you, here's a weekly chart of the NASDAQ. We're off 24% or whatever from the highs. If you go through the stocks that make up the travel, and specifically hotels, let me just go down from weakest to strongest within the hotel stocks, and I'll tell you what we're looking at. So here's Intercontinental Holdings. Here's Marriott Vacations. Here's Hilton Grand Vacations. Here's Vail Resorts. Here's Hyatt. Here's Choice Hotels. Here's Wyndham, Marriott International, Hilton, Extended Stay, CVO, which I got to be honest, I don't know that one, CVEO. Do you see the difference in the shape of those charts? Where the NASDAQ was dropping, Amazon's getting hammered, the other tech stocks are getting hammered, travel stocks are doing extremely, extremely well. Travel and tourism, Bookings Holdings was up today. Expedia is a holding in our group that did have some poor earnings and did come off a little bit, but it showed a lot of relative strength. Restaurants and bars are doing well. So I think the takeaway for this that we're saying is I think the consumer, despite inflationary pressures, is still strong, and these charts and stocks that we're talking about show you that to be the case. I think they have their financial balance sheets in order. They recognize when prices are going up and they're cutting what they don't need, and they're traveling, they're getting out. So maybe the consumer is going to save us again.
Yeah, if you can bring up the one chart from our document, and I think. Yep. As I'm looking at sort of underlying glimmers of hope or optimism through kind of this sell-off and what we're seeing, and and even if we are headed towards a somewhat of a recession. I mean, we don't know. It's hard to predict in advance, but the one, if you go down to, I think it's the next chart down. Yeah, it's the next one down.
Let's
the
see
loan
here.
to deposit ratio.
Got it. Okay, yeah, walk us through this.
And I saw this. I think it was actually from Liz Ann Saunders shared it today on Twitter. I saw it, and the thing that struck out the most to me that I saw is the two big humps for 1999, 2000, and 2008, 2009. So this is loan to deposit ratio. So essentially showing how leveraged maybe the average consumer was. And so in 2000 you see high leverage. You go to 2008, again the average consumer was very levered up at that point.
Yeah.
And we've come back down off of that. I think people got pretty shook through the global financial crisis. And as we're at today, you can look at it in a way and say, well, that's not great if people aren't borrowing and aren't spending. But on the flip side, people have their cash in the banks. They're well financed. They're not over leveraged. So that if we do see a slowdown in spending, which may happen to a degree, I don't think we have to see this massive bear market, long drawn out recession. I think it'll be relatively shallow, and some of these indicators and underlying sort of economic data sets give me a lot more confidence of where we're at. I think right now most people are just really scared of inflation. I think some of these companies, especially some of these techier, newer growth companies, got a little bit ahead of their skis, especially during the COVID environment the last 2 years, and the market's finally shaking all this out. And hopefully we'll get to a more normalized sort of pattern and environment as we move forward, and hopefully out of this COVID. And to your point, you brought up earlier, we're still dealing with geopolitical issues, right, between Ukraine and Russia. We're dealing with China still on lockdown from their COVID because they wanted zero COVID for the last 2 years, where most of our country has had it now, and I feel like we're almost immune to it to a certain degree in terms of kind of moving on and moving past it. It's still not something to take too lightly, but the mentality has certainly shifted here. And our supply chain issues are just getting, again, being hit so hard in China, and that's going to disrupt things. And we just got to get past this phase. And it's just hard. It's hard to take year over year, quarter after quarter data and make a big, say of what's actually happening, because we've just been so disrupted, and we continue to be disrupted right now. As we're kind of getting to closer to the midway point of 2022.
Yeah, and I mean the good news is at some point this will pass. I don't think we have a majority of the Nasdaq significantly overvalued, with shell companies not making any real earnings that created a Nasdaq wide collapse. We just don't have that. We have companies like Apple making $100 billion a quarter. I mean, just crazy, 80, 90 billion on a light quarter. Apple, our friend Tim Berkwin is in here. He's an old friend. He ran the Traders Expo. He's one of my dear friends. He was at my bachelor party in Vegas, where we went to, I think we started out the afternoon at the library, Tim, and then we proceeded to the gym and had some sushi. And no, just joking. It was pretty
lights out by 10.
Yeah, that's all. It was. We actually did play golf. It was fun. Tim's awesome. Sorry to call you out, but you said that. But it will stabilize. Just looking at Apple here real quick. I mean, you're looking at trailing 12 months revenue, $484 billion over the trailing 12 months. They have, just looking at, they're working on a gross profit margin of 43%, operating margin, 43% operating company, making $500 billion a year in top line revenue. Crazy. Unbelievable.
And their biggest concern out of their earnings call last week was the supply chain side.
Yeah.
They weren't saying anything about demand. It was all, China and supply.
And they said they're even like we're not immune to it. So if we just look at Apple here real quick, and I know we're coming up on our time, I got just a few more things. You just look at some of these stats here. We're trading 25 times PE. So we'll look at that means we're showing only 25 times forward earnings. So if you go to estimates here, Apple in 22 is looking to make $6.14 a share. So you just do 157.07 divided by, what did I say, EPS of 6.147. So trading 25 and a half times forward earnings. The S&P is down about 19 or 18%. 19 or 18 times forward earnings, and the S&P, I think should come down to about 16 or 18 times forward earnings, which I do think, I do believe we'll get a sub 4,000 move in the S&P. I don't think it's going to be, too much more than that. Let's talk quickly, if you don't mind, earnings. Earnings so far this year. I've got some stats from FactSet. I'm not going to pretend like I memorized this, but I thought these were interesting. I'm going to throw by you. Year-over-year growth rate for earnings so far Q1, so we're in Q1 of 22 compared to Q1 of 21, is the growth rate is 7%, below the 5-year average of 15%, 10-year average of 9%. So the 10-year growth average is 9%. Right now we're at 7%. Almost 3/4 of the companies out there are citing macroeconomic factors, which is inflation and supply chain, as well as geopolitical, which is Russia, Ukraine, as headwinds. And this is interesting that the head analysts there at FactSet point out. The 7% year-over-year growth rate without Amazon's, call it foolish investment in Rivian, creating a $7 billion loss, the year-over-year growth would be 10% in earnings over the year. The S&P on a 5-year average, positive EPS surprise, this right now, 5-year average, if you beat earnings on average the last 5 years, the stock goes up 0.8%. Right now, in this kind of environment, with a positive earnings surprise, the stock is losing 0.4%. S&P companies that don't beat, that miss earnings per share, 5-year average, that when you don't meet your expectations, you're down 2.3%. Right now, a company that misses on EPS is down 3.9. So the companies that are making money are not being rewarded. The companies that are missing expectations are being punished. It's just the kind of market that we're in right now. So we do have a lot of earnings revisions. A lot of analysts are coming out and revising earnings down, so the bar will be low for coming earnings. And I'm just looking at a couple other things, looking at credit spreads real quick. I just want to throw this out here. There's not too much. This is a little bit more into the weeds in terms of where we are with credit spreads. So what you're doing is you're looking at the yield on the safe 30-year Treasury, and I say safe, against triple B, which is a little bit more of a lower down on the more risk scale. So it's a little bit more of a speculative bond yield compared to the 30-year. So we have triple B in orange and 30-year Treasury, which is the safe in blue. And you can see that as the spreads between the two, as the triple B spread gets higher, remember a bond price is sold off, so the corresponding yield goes up. And when you go into credit crisis, risky triple B bonds are sold off, which sends their rate higher, which creates a very wide spread between the two. I kind of have it reversed here. So what I'm doing here is you can see in recession, which is gray, during 2008, the spreads got very narrow. Usually it's triple B minus the 30-year. I switched it just to correlate with the stock market. So in 2008, you can see stock market sold off. These guys got very low. We had a lot of volatility here in 2016, 17 as the Fed started to raise rates. We started to get lower spreads. And you can see, barring some kind of astronomical thing, like a tech crash. Tech crash spreads got to minus 1 point. I'm watching this number right here, about 1.45%. 2008, they got down to minus 5. So the short recession got down to minus 2.5. We're coming into a point where the spread is getting low enough where we start to see some support in the yield spread chart to start to say that, perhaps it doesn't get much worse than this. But sentiment has to change, and the biggest thing that I think is this AAII. Well, we mentioned this, but I think it's really, really important. Just look at the investor sentiment. Horrible, horrible investor sentiment. You're looking at lows that you haven't seen in, you haven't seen lows even back 10 years. You haven't seen sentiment so bearish as we've seen now. The lower this purple line becomes, the more bearish people are out there. And what happens is markets always turn when the data doesn't seem like, it seems like it's just going to continue to get worse and worse, and people are just going to get out and eject at any price, which is known as capitulation. Markets always bottom when things seem to be that they're just going to get worse forever. So the market doesn't bottom on good news. It bottoms on horrible news, where people just throw their hands up in the air and say, get on with it. So earnings continue to be good. It's just sentiment needs to change around everything that's going on with the Fed in a very precarious position that they put themselves in, geopolitical pressures, and sentiment in the market has to change. We've got to get, I think Russia under control, and I think that's going to start to help change sentiment. But it's dark right now. But Ryan, you've been in wealth management a lot longer than I have. I've been trading, my own account and trading for, showing other people how to trade. You've been running money, at a large firm for over a decade. I mean, what do you tell people, in this kind of environment?
Well, it's good to be tactical. It's good to be able to take advantage of some of the opportunities that are out there. But this is and it's easier said than done. But it's so much. It makes this sort of volatility a lot easier to weather the storm when you have a plan. When you know things, are on track. When you know that you have, whether it's cash or something, low duration that you can pull from for that cash that you need. I mean, there's nothing worse than needing to sell out of a position at 20-30% down, because you have a spending need that you've known about, but you weren't prepared for it. So having a plan, just being well prepared to weather these storms, because they're going to happen. That's really what's key in all of this. And like I said, it doesn't make the down days any easier per se, but knowing that you do have a plan, and when you can look at it, even in the volatility, it's going to be successful, or it's trending to be successful. It gives people a lot of confidence and a lot of peace of mind. And I've seen that, through the years, that's the biggest difference is, right, those folks who have a plan that we've been working with for years that are, hey, I know I'm good with this, I'm comfortable, versus people who are calling that haven't had a plan. They're like, I don't know what to do, I'm really scared right now. And there's a huge difference. There's a huge difference between the two. So that's, key there. Easier said now than when things were good, but moving forward, I think that can help a lot of people.
Yeah, and that's why we're sort of helping our clients just sort of get through the day and get through this period. Tactical asset management is very important here, being in the right sectors and industries and stocks, because there's stocks that have gotten decimated to 80%, and there's stocks that are up around the highs right now that are responding to this inflationary environment and the position that the Fed is in. So tactical asset management combined with a good plan, a good financial plan, tax optimized, know where the money is going to come from, know the appropriate amount of risk for the reward you need for your particular situation. And that helps you get through this. It doesn't matter, like when I used to trade for the hedge fund, if it was a 2-day trade, you always have a plan. If it's a 20-year trade, 20-year investment, you have a plan, and that helps you get through it. If you don't have a plan, that's when you start making emotional decisions that cost you.
For sure. All right, let's leave it at that. I think that's a good way to wrap today up, and let's hope for a good close to the week tomorrow. Fingers crossed.
That's it, man. Good job. And thanks, everyone, for listening. Check us out at New Age Wealth Advisors. If you're on the YouTube window, tickle that little thumbs up button if you don't mind. Let YouTube know that we're back and putting content out on this channel. So thanks for listening. Hope you guys are well. See you guys next week. See you, bro.